Good afternoon and welcome to Markets Today. I'm your host, Odhiambura Mugi. As usual, we have a tendency to have a look at what happened in the market before we delve into our conversation. Naturally, the markets are up. All our indicators are in the green. We have seen the all-share index come up significantly. Perhaps we'll have a look at the gainers, the losers, and the movers first before we go into our conversation. And to start us off, Unga Group is topping the charts at 9.52% upwards, having moved to 36.25 shillings in the day, up from 33.1 yesterday. East African Cables is also making the headlines, having increased their value at 5.98% to close the day at 1 shilling 24 cents. Home Africa is up to 38 cents. This is 5.56% up. WPP Scan Group is 4.23 shillings, being 4.44% upwards. Express Kenya is up 3.95%, closing the list of those who have gained today, having closed at 3 shillings 95 cents. Let's have a look at the losers of the day. Olympia Capital closed the day 5.37% lower, having settled at 1 shilling 94 cents. Nairobi Business Ventures is down 2.56%, closed the day at 4 shillings 95 cents. TPS Serena is 2.17 lower, having closed the day at 13.5 shillings. And Stanlib FA closed the day at 6.32 shillings, being 1.25% lower. And to close the list, British American was the smallest loser, closing the day at 430, being 1.15% lower. The movers of the day are your regular big boys, I think with the exception of Centum Investment. Safaricom PLC traded 14.5 million shares. Equity Group Holdings traded 1.8 million shares. KCB Group traded 1.3 million shares. The top three having traded over 1 million shares each, with Safaricom taking the lion's share at 14.5 million. Centum made it to this list today, having traded 626,000 shares. And Absa Bank also made it here at 236,000 shares. Most interesting movements of the market. We are joined today by Mr. Wafubwa, who is the CEO of Enwealth, to have a conversation on pensions or the state of pensions in Kenya. Karibu sana, Mr. Wafubwa.
Thank you for having me.
Excellent. Interestingly, we were friends before this, and we get to meet on screen.
Imagine.
What do you make of the movements of the market, your observation?
I think we are picking resilience, that despite the volatility we are experiencing in the market, there are those on one side who are seeing opportunities to plant and optimize value when the markets rally up. And then there are those who are also selling to be able to crystallize the profits in the investments. Of course, there are also those who are responding to the political climate and taking perhaps a little bit of safe positions.
Yeah.
Yes.
Well, today I would love us to have a conversation around pensions, considering the fact that this is your forte.
Yes, thank you.
Would you perhaps just explain to us what is the status of the pension industry in Kenya?
So the sector has continued to grow. We are at about 1.5 trillion Kenya shillings in terms of the industry value. That includes NSSF, with about 3.5 million members in the sector, pulling in both the government side and also the private sector. There's huge growth we're experiencing in the umbrella sector, where small, medium enterprises are seeing value to save for the future. And so organizations that cannot afford to have their own pension set up, they are pulling it through umbrella. Again, on the other hand, the retail sector, the jua kali sector, through the individual personal pension plans, equally have gained momentum. Yeah.
Now, that's quite interesting.
Yes.
But 3.5%, 3.5 million Kenyans,
yes.
Against a backdrop of 20 million workforce.
Yes.
That's quite small, eh?
It's quite small, but if you compare in the region, we are doing well. But I do agree that we still have a lot of work to do to be able to enhance coverage. I know that the regulator, the Retirement Benefits Authority, have been on it in terms of building awareness, capacity, and also putting in place incentives for most employers to put in place pension programs instead of gratuity for the employees. And I think it's also partly because they don't know. Gratuity, you know, did you know that if you have gratuity, you are taxed at 30%?
That's right.
And there is no growth by way of investments, return on gratuity. And gratuity, you accrue that liability in the employer's book. So it makes the balance sheet not very tight.
And so it's not a win-win.
Correct, but when you pull that into a pension program, the funds are separate from the employer, so there is safety, there is tax benefit both to some level to the employer and also the member in terms of tax reliefs provided in the income tax, and also the funds are growing. Like as at looking at some of our reports, our portfolios, some of our funds, as at that 1st December, we were at 12% return, and that's good.
In a year?
Yes.
Absolutely. Is this net or gross before?
No, that's gross for some, but probably you look at a net of about 11%.
Okay.
Yes.
And I agree that, you know, pension is a better offer.
Yeah.
But I've realized, Mr. Wafubwa, that a majority of my viewers, in fact, very many, are young people.
Yes.
They are the ones that are not saving for their pension. Could you perhaps explain to them the difference between a pension and a gratuity?
So gratuity is where the employer gives you a promise provided in your employment contract that for X number of years you work with the company, for each year you will get a certain percentage of your salary. That's gratuity.
Okay.
It's formalized in an employment contract. When you leave, the employer looks at your years of service times your salary and what you call the gratuity accrual rate. In a pension program, the employer puts a percentage of your salary is deducted, and they also contribute into a kitty that is licensed by the Retirement Benefits Authority. And that word licensed is key because in there is a promise of safety of your savings. We have stringent governance framework within pension to safeguard member saving. For example, the funds sit in a custodial account in what we call nominee account. Even if that bank collapses, the assets under nominee are off the balance sheet of that bank. That's a huge plus.
Yeah.
And two, where we invest is guided by law. We cannot just maybe put money in a quarry, no. And the wisdom around it is to safeguard the member savings. And then three, there are clear checks and balances with segregated mandates that you have a fund manager, custodian, administrator, and either individual or body corporate trustees who are providing oversight on the governance framework of the pension
So
arrangement.
it's a very airtight, legally speaking, investment.
Absolutely.
Yeah.
Yes.
Are we saving enough as a country for, I know, I was looking at some figures,
Yeah.
and I realized the Chinese save over 60% of their earnings.
It's called the income replacement ratio.
Yes.
So income adequacy is where you build enough savings that when you project your salary at retirement, say at 50 or 60, the last salary that you earn, if it's 100,000, you need to target at least 70% to be your pension.
Yes.
So then 70,000 becomes your monthly pension. And here is a quick, easy way of calculating from your lump sum to your monthly pension. You take just 1% of your total savings, that becomes your monthly pension. For example, if your total saving at age 60 is, say, 10 million, 1% of 10 million is 100,000. Estimate that will be your monthly pension. And so the reason why we need to have at least 40%, according to World Bank, income replacement ratio in our market is that we have high inflation. By the time you start off earning your monthly pension at age 40, at age 60, by the time you get age 90, the value of your pension may come down by less than half because of inflation. 2, dependence ratio is high. For every 1 shilling a pensioner is getting, especially in some region of this country where the cousin of the neighbor or the brother is still a relative entitled to that pension.
Or the person who prays with your mom in the same church.
Correct.
That one, even when she's sick, your mom has to have to call you.
Absolutely. And so you find almost 20 people depending on that. So then the adequacy and sustainability to meet the financial obligations of your mom in the village, that pension, it gets to be depleted.
Yeah.
And then, of course, the risk of healthcare, that just in one single admission, all that someone has saved can be eroded. And then finally, this is very interesting, out of some research we did with Strathmore, we noticed there's a phenomena of where challenges arising out of modern day parenting. So parents are doing second-hand level parenting, taking care of their children's children, even in retirement. So the work of their children is to go and bring other children.
That's very sad.
Very sad. And so you find they still have to use their pension to pay school fees and upkeep for those kids.
Yeah. That's an interesting subject that I'd want to explore much later. But for now, there was a report that only 1% of us get to live the same lifestyle after retirement, the same lifestyle to what we were living before retirement.
Yes.
In principle, 99% of us are not ready for retirement or do not prepare adequately for retirement. I don't know what your thoughts are on this. And if there is any recommendation you'll make.
Yeah, so I may not really speak into whether 1% or not, but the reality is that it may not be far off from that. And there are a couple of reasons why. Because of job mobility, most people end up having early access of their pension savings. And by the time they get to retirement phase of life, they haven't then built adequate income to be used for monthly pension. My recommendation is, whether one is changing jobs or not, don't touch your pension. It's for your future. If you eat your future now, Fred, your future will eat you. It will have nothing else. Okay? And then 2, there is a huge need for financial literacy programs at early stage. I think within our labor laws, we need to make this mandatory. that it should be an obligation both ways, annually, for members and also of employees in any organization to be walked through financial literacy programs so that they also build their future.
Yeah.
There are some mistakes people make because of ignorance, but if they had proper information, they may have used that information early enough to be able to better their future.
Yeah.
And so I think there's need to have information early enough on financial planning, and also make it mandatory to save for retirement with no access. And then finally, we need better tax structures to govern pension so that we don't have, we need to have higher, greater incentives on from a tax view on pension.
Yeah. Well, there is a general opinion that as we are going into an election year,
Yes.
this probably will be one of the best years we've had because we foresee a significant recovery from COVID-19. And many analysts agree to the fact that the economy will grow significantly.
Yes.
Do you think this is accurate?
I tend to think so, that our political systems have matured and in a way immunized substantially.
Yeah.
I think against political upheavals that we may experience. And I think culturally Kenyans, we are very resilient, that no matter what we have to pull through. We've seen this in the past, and if I may just speak a little bit in the past, it's been all through VUCA moment, extremely volatile, uncertain, complex, ambiguous in the pension sector. When we had 2016 the concerns of Imbirio and Chase Bank, the markets really responded in a very unsupportive way. And then we had the capping.
The interest rate capping.
Yes. Then from there we have the elections. Then COVID hits. Then we are here again, election. I think from an investor perspective, when things keep happening like that, you get used. Then you say, this is after all the reality of any market.
Yeah. So
what must I do to respond to these opportunities? In moments like this, the pessimist will expect the wind to change. The optimist, of course, will say perhaps it will settle. But those who are really taking leadership, they will adjust the sail.
Yeah.
You pair up opportunities and take it that this is a planting season.
In which way then is the pension industry prepared for the boom, for the change of circumstances?
So I've seen a push for diversification and to have also a share of the infrastructure, which is happening big time. And infrastructure remains a key backbone for our economic sustainability, and we are seeing it across the country. In there lies opportunity, and you see you are pairing long-term capital to long-term projects. It's called asset liability modeling. And that's an opportunity the pension schemes are now exploring to pump in investments into green energy and also, of course, infrastructure development.
Yeah.
Also, private equity funds coming in the agri-space, because we are projecting growth in the economy as well as growth in the population. We might be around 75 million by the year 2050. The constant there then is that we have 75 million mouths to eat. So agri then becomes an opportunity, and it's just to value chain in that space and generate a fair return for those who are saving in the pensions. So other than then just having concentration risk in one particular stock, I think there's then opportunity to optimize diversification as part of risk management.
Okay.
Yes.
Are there other countries perhaps that we are benchmarking in terms of their pension management,
Yeah.
especially in an election year, a highly volatile season?
I wouldn't say I have one that comes in straight in the mind, but if you check pension systems like in Singapore, the Central Provident Fund would provide 3 benefits. One is housing, a healthcare account, and also income replacement. That's the model that I see our sector adapting to. Right now.
Say that again. Housing,
healthcare, and income replacement. When you check our nation, that's our legislative framework now has provisions for members to save for healthcare, to pre-fund, it gets cheaper, and also housing. And as Enwealth, we've already gone ahead to have set up an affordable housing mortgage unit to be able to support those members who want to use their 40% of pension for the purpose of home ownership.
Mr. Wafubwa, you are preaching to the choir, especially there on the package of 3.
Yes.
And I'd really love to hear some more about it. But we have to take a break before my producer gets on my neck. Ladies and gentlemen, I'm talking to Mr. Wafubwa about the status of pensions in Kenya. And he's given me some quite good insights about the income replacement. But I significantly like the idea of Singapore that you get a package of 3, housing, healthcare, and income replacement. Or should we just say income in your retirement? Income replacement sounds technical. When we come back, he's going to tell us more about this. Don't go away. Stay tuned.